Welcome everyone. Good to have you all here. We're going to let more people come through. We normally have most of the wave come in by 12:03, so we're going to give everyone about a minute or two, and then we'll get started. Today, our guest is Ryan Walsh, the CEO and founder of RepVue, and we're going to be covering everything about stock options, equity, a lot of different topics. And I purposefully set aside time because I know people are going to have specific questions on their own situation, and so I'd encourage you, if you do have a question, if you are just curious, if you actually have stock options, if you want to go through your own personal scenario, feel free to drop that in the chat and we will queue up people to either come on live or we'll be able to read your questions. So feel free to drop those in and you'll get the first shot to do it. Darren, what's up? Good to have you here. Justin, looks like you and the crew are calling in. There's multiple Justin Brocks on here, so it's good to have you here as well. Megan, good to see you here again. All right, let's get into it, and more people can show up and they can catch up. All right, everyone, welcome back to this episode of the Demand Gen Expert Series. Today we have Ryan Walsh joining us, the CEO and founder of RepVue. I've really enjoyed watching Ryan's content and perspective from afar, and he was actually recommended as we were talking through when Rand Fishkin was on here on the last episode, and we started talking through stock and equity and VCs and things like that. There was a lot of questions that came up in the chat inside of the AMA about what is the situation for my stock options, or could we do more episodes about this? And so you ask, we listen, and we brought Ryan here, who has been through, we were talking before we got on live about all of his different experiences, both as an employee and as a business owner that is then, giving out stock options. So and I'm happy to share some of my own experiences as well. And so we're going to go through a little bit of a roadmap, and then we will have guaranteed time for questions. And so if you do have questions, feel free to drop them in the chat. We'll get started. And without further ado, Ryan, awesome to have you here.
Awesome. Thank you so much, Chris. I appreciate it. I love the topic. It's near and dear to my heart. I'm passionate about it. As you mentioned, I've had incentive stock options, NSOs, which are non-qualified stock options as an employee. I've had RSUs as an employee of a public company. I've had vesting. I've had splits. We did an IPO. I'm a founder now of a corporation, and we give stock options out, typically incentive stock options. It's complex. So yes, I do. We get a lot of questions. I know you get a lot of questions. So this is going to be awesome.
Yeah, so to get into it, we're going to try, for people that are on here, we're going to sort of gloss over the 101 stuff. So if you're looking for like the main basic definitions and things like that, please feel free to reference Google or Wikipedia or another source. We're going to get more into the detailed topics, and we did collect a lot of questions in advance. But there was one sort of like 101 level topic that I thought was interesting to cover here, which is just basically, could you describe the difference between stock options and stock?
Yeah, I mean, there's several different forms of equity that you can get in companies typically, and this is not a hard and fast rule because units are sometimes given in later stage companies that are not public as well. But an easy way to think about it would be an incentive stock option or a stock option. There's also what's called a non-qualified stock option, which is another form of stock option. There's tax differences between those two that we probably won't get into too much today. But most employees would get incentive stock options if it's an early stage startup. And it's essentially, it's a contract that enables you to purchase shares at a set price over some vesting schedule. Whereas RSUs, you're essentially given units. Like I received RSUs during the latter part of my career at the last company I worked for, which is a public company. And you're given units. There still is a vesting schedule. Say you're given 10,000, but when those are available, you get them, at that price, and they're taxed. So I think an easy way to think about it, if you're given like stock units, particularly for a public company, it's going to be more like income, right? It's one of the things, like I know Amazon does it, AWS, they do it for their employees. Like, oh, here's your offer. It's 100K base, 100K variable if you're in sales, and you'll get 10 units, right? Now Amazon's, that's, $2,500 a unit, right? So there's some real money there. Right. And so it's really, that's really the core difference. Whereas incentive stock options or stock options in general are essentially the potential or the option. It's called an option because you have the option when it vests to purchase it at a set price, and that set price is typically a much lower than fair market value. And by the way, the price that you get, like, which is in your agreement for options, your exercise price is what that's called. That's set in a separate process than how the valuation of the company is determined, which the valuation of the company is determined by what the founder can sell it for, right? I'm going to go raise money. Well, I just negotiated and the company's worth 10 million or 20 million. The exercise price is going to be significantly discounted off of that as a general rule, and that's how those two things are set. But so that's just the basics. Most employees that are given equity in pre-IPO companies, it's some form of stock option with a vesting schedule and exercise price, and you're trying to hopefully help make the company worth more than on a per share basis than the exercise price.
Mm-hmm. And then I've found that it's common, you sort of alluded to this in your last statement, so I think we can go into it now. I found that it's common for VC-backed startups to offer stock options, but there are many other types of businesses that do not offer any type of stock options, and I'd be curious as to sort of why you think that is, or what the underlying details as to what drives that.
Well, when you're talking about earlier stage VC-backed companies, in many cases, they don't necessarily have, like, if you're competing with a large corporation that maybe is either profitable and private, or it's a public company, or you have a harder time competing on just cash compensation, right? And so what you're selling, and I'm going to use the word selling here, as a hiring manager or recruiter, you're selling, quote unquote, the dream of, hey, you're coming into a startup, look at all these people that have made all this money in this startup. Oh my gosh, you could be rich, you could get this, you could get that. It's not all nefarious like that, but it's something that I know we'll probably talk a little bit more about. But bottom line is that it's a selling advantage that startups and earlier stage companies can use is equity. And if people post on LinkedIn, your VP of sales, you make X amount of dollars. Well, you'll take less at a startup because you're going to get equity. And it's the job of the employee to really try and make a determination, setting aside like quality of opportunity, of which, by the way, that's what we do at RepVue, is help people figure out the quality of the opportunity. But setting aside quality of the opportunity from a strictly financial standpoint, if you have an offer at 150K versus 100K, but you're going to get equity in the 100K, well, you're losing out on 50K for 3 years, 4 years, 6 years, right? That adds up, right? So then how do you determine, whether that, whether, and you're getting that money immediately now, sooner, versus like waiting for some potential big exit that could happen. So, I think a core reason is that, and there are some early stage companies that just don't do it. They don't give equity. Most public companies, at least in tech sector, will give equity to a lot of employees, not all junior employees, but more strategic employees. A lot of salespeople get it. So yeah, I mean, it's the upside is what is appealing to people that have the appetite for risk in earlier stage companies. It's the upside of potential equity.
Mm-hmm. So I heard talent, like acquiring or attracting talent, to be one of the main drivers. I was curious, and I really just don't know the answer to this, so I'm going to ask. Like, does it have anything to do with the business's profitabilities, like whether the company makes a profit or not?
Only from the standpoint of companies use equity as another form of quote unquote payment for various goods and services. And those various goods and services could be an employee, right? I'm paying them maybe a little lower than market or a little lower than I know they could go get somewhere else, because they'll take the risk of getting compensated in equity. Or same thing, sometimes service providers first, engaging with earlier stage companies. Well, we'll take some of the payment in equity. We'll do this in exchange for equity. So it's not really a direct association of profitability outside of the standpoint of, if I need to really conserve cash and I need things done, can I leverage this as a form of compensation to some third party that is providing a good or service to my business?
Mm-hmm. going to start getting into the meat for people, this is probably a question that a lot of people are thinking. So it's, we've talked about all these different like technical things, but how do I make money on this stuff, Ryan? How do I make money with my stock options?
Well, first of all, the bottom line is if the company doesn't do well, you're not. Like, period. Like, you will not make money. Like, it's highly unlikely. And if you do, and the company's not doing really well, then it's not going to be much money, right? So there's certain nuances in how equity works at a corporate level that people need to understand, right? So first of all, if the company has taken institutional investment, i.e. venture capital dollars have been put into that company, those venture capital investors are ahead of you in line, right? And what that means is that if the company, well, first of all, if the company does really, really well, everybody has potential to make some money. If the company, and let's come back to that scenario here in just a minute. Like, what happens if the company does really well? Then how do I understand if it can be worth a lot of money? But let's start with the scenario that maybe it doesn't do well, right? Let's say you take a $2 million venture capital investment, and at the time the company's worth $10 million. Well, that's great. Well, typically at a minimum, that $2 million investment comes with a 1-for-1 return in terms of, like, if this company gets sold or liquidated, like, I'm guaranteed 2 million back. Okay. If it's under 2 million, then they're going to get all of it basically in some way, shape, or form. But say it sells for 2.5 million, keeping in very, very simple math, they get their 2 back, and then the $500,000 is split up by everybody else. Okay. Even if they only own, technically at the time of the 10 million, they only own 20% of the company at that time. They will get all of that back. That's called a preference stack. You can, where you sit in that, it's a very, very common equity term. People can look that up, right? So the question is, how do I make money off this? How do I profit? How do I gain off of these stock options? A lot of it, whether or not you gain off of stock options is primarily determined by the decision of which company you join, right? I mean, the bottom line is, if the company does really well, you have the potential to earn money. If it doesn't, you don't. And then how do you gain is you only gain if you have equity that's vested at the time of a quote unquote liquidation event, which means either A, the company is acquired by another company, PE firm, somebody, or it potentially goes public, which is a little less common, of course. But at that point in time, your shares would convert potentially to cash, right? Or another, if it's acquired by a public company, it's potential to convert into public company shares. But at the end of the day, you have to understand the math of your set of shares, and then I always like model potential outcomes, right? And I think there's a really big gray area, and this is on companies to do a better job. And Chris, before we jumped on, you were kind of telling me about, like, hey, I feel like I got burned a couple times by equity in my earlier days. And this is what happens a lot of times, and your scenario is very common. What happens is you start at a company and they say, here's 1,000 shares. Oh, that's cool, because maybe it'll be worth $15 a share one day, well, that's $15,000, or 10,000 shares, and then $150,000. The reality of it is, you don't know what that 1,000 represents, either in a kind of a dollar standpoint or a piece of the pie standpoint, right? You'd be surprised that many companies, when you say, oh, you got 5,000 shares, well, they have 200 million shares. Okay. So if the company sells for $200 million, then they're worth $1 per share, rough math, right? So people don't understand it, and it is for everybody on the call, it is a legitimate, viable question to ask as part of the offer, which is, 5,000 shares. Well, either, what is the price per share at the last fundraise, right? Which would give you a good sense of the value at that time. And then, or how many total shares are there, so I know what percentage I own. And I actually prefer the former. And as a founder of a tech company, we share this information with our employees, and I think I think we use Carta as well, which helps companies manage the equity. And in ours, we make the total number of shares visible to our employees as well. But so I can say to an employee, hey, here's 2,000 shares. Okay. The exercise price is, I'm going to make up these numbers, but so the exercise price is 25 cents, right? So over the next 4 years, you'll have the ability to vest these shares and you can purchase them for 25 cents a share. We just raised money. We did a fundraise. At the time of the fundraise, the valuation on a per share basis was $1.25. Okay. So right then, you have a really exact calculation is what is the real value, which is 125 minus the 25 cents. You have a real understanding of that. And then you can benchmark that in the future. Like, oh, if so and I also say, and the $1.25 represents this value of our company was valued at X, at 10 million, 15 million, 20 million, whatever that number, 100 million, whatever that number is. And so as an employee, the information that you have and the information that is I can buy each share for 25 cents. As of right now, today, if nothing changes, the value of that share is $1.25. Okay. And then what's going to happen in the future are a couple likely scenarios. Number one, a lot of companies, if it's early stage, they'll probably raise more money, right? When you raise more money, what the information as an employee that you want to understand ideally is, all right, what's the new price of the share? What was it sold at? What was the CEO able to sell the shares at? Okay, well now it's $3, right? Or with all this economic conditions, some of the macro stuff, like read about public company valuations, you see that's going down, like some private company valuations, some of that trending. What is it? Did it drop to $1? And so you really have that knowledge of what is the actual value per share. And then the last thing I'll say, and then I'll pause for some follow-up questions, is how do you actually make money on it? Well, the most likely scenario is that you're going to leave before there's an exit. Okay. And so if you leave before there's an exit, typically you have incentive stock options, and you have 90 days to exercise those options. And that's actually, I believe that's like a taxation thing. If you don't do it within 90 days, it triggers a different type of tax, but that's neither here. You have 90 days. And so what do you have to, I have to decide, I have 1,000 shares. Let's say I have 10,000 shares and they're 50 cents each. I've got to literally cut a check for $5,000, right, to exercise those options. Why would I do that? Okay, well, that's where you got to look at the numbers. Well, right now, if each share I'm buying for 50 cents and they just said they raised money and the value is at $2, I know there's 20K there. And so what are the possible outcomes? Number one, it could still go to zero, period, right? It could still absolutely go to zero, and it happens all the time, and you're out $5,000. $5,000 is a lot of money, right? I mean, that's real money. It's real dollars. You're sacrificing other things if you're going to cut that check. And so that is probably one of the toughest decisions for early stage employees is to figure out should I exercise my options? And I'm giving you the scenario of how to make the decision to exercise options when you have the ultimate, like most information that anyone would ever have. You got burned and other people get burned because they have no idea, right? I have no idea. Like I had to pay, all you know is this $5,000, right? And you don't know, like right now it could be worth 3,000. And that doesn't mean it won't be worth more than that in the future, but you just have no idea. And so I think it's within your rights to ask when you start and at a regular basis, like, especially when you raise more money or do like, hey, what's the new price per share? Like what? And it's almost like, what if I offered you a job and said, hey, it's 100,000 something, but I didn't tell you if it was dollars, euros, rupees, right? But it's 100,000. Right, and then you don't know what it is, and then you check your bank account on your 2-week mark, and you're like, oh crap, it was rupees, and now I'm screwed, right? It's like the same concept. You have no idea, and so there's a lot of variables out there. Most of the confusion, most of the angst comes because companies are not disclosing a minimum amount of information for employees to make better decisions about joining companies and whether to exercise when they leave. So that was a lot.
Yeah.
You might have been taking a few notes.
I took a lot of notes. I got a couple of follow-up things, just a couple of key points to hammer in for people, and then some follow-up questions. From my understanding, and you correct me if I'm wrong, but my belief is that the only way that you make money on stock options is during a liquidity event, right? So you don't really, stock options are very much considered, and even stock in a private company is considered a very illiquid asset, especially for an employee, which means that it only becomes actually, you can only extract value from it if the company decides to sell or go public or another type of liquidity event. So you don't have much control over the timing of how that happens or if it ever does.
Yeah.
So that's
There are like some quote unquote secondary markets that can potentially trade in private company equity like that if you have exercised and own those shares. And so that is possible. If you do that, typically the company would have right of first refusal to buy those shares from you instead of selling them on the open market. So it's not like a zero never happens thing. It's just the primary way that it happens is through a liquidity event. Large later stage fundraisings can also count as like sometimes when new investors come in at a much later stage, they want to have a certain amount of the company, and the company itself will allow employees to liquidate their earlier shares in that later fundraise. So it's not a true exit event, but it's another kind of financing event that occasionally that will happen. It's not super common, but it does happen as well. So I don't want to say like it's 100% black and white, but for the most part, it's it's a liquidity event that will happen.
Yeah, like when a PE firm like Vista comes in and buys 70% and something like that potentially.
Yeah, that certainly would likely trigger much of an ability to liquidate. But even at a a large VC round coming in like a Series D or E, et cetera, and they put you see these $150 million rounds, these big rounds that you see a lot of over the last couple of years, pretty much without fail, like the senior people, the founders are always liquidating their personal shares in that. Not all of their personal shares, to be clear. They're still maintaining, and the investors would require that they maintain a certain amount of equity because they're aligned with the vision and all that. But certainly, like you see $150 million, and there's two founders, they're both, probably pocketing, I don't know, 5-10 million. There's some ratios related to how big companies, how much revenue they have that they look at for that. So that happens. And then occasionally those founders will say, hey, there's demand, and it's based on demand. There's demand for additional equity from the investors. Where can we get that equity? Would any employees want to sell your, and this is where it comes in. I can exercise them at 25 cents and now they're buying them at 250. And then you make a decision. Basically, it's like, do you want to de-risk and sell some, knowing that, hey, if you think this company is really taking off, like maybe a couple years, it might be $5, but at the same time, very, very risky. So it's always, a consideration to take a little bit off the table there.
Yeah.
So that scenario does happen. It's not super common. So I want people to probably keep it in their mind that for the most part, to get cash from your equity requires either an acquisition or an IPO.
Yeah, and then I wanted to go through just my experience and how you mentioned a couple of different ways to calculate the value, and so I wanted to go through my experience. I joined a company as a senior manager. The company when I joined, had just finished a Series C round. While I was an employee, they also raised a D and an E. So the total money raised by the company at the time of a liquidity event was over $300 million. And so what I did is I think I had 30,000 shares total after all of like the bonuses and all the things that went into it. And so I said, I have 30,000 shares. I went and had to figure out how many outstanding shares are there. And so then I went and figured it out. It was hundreds of millions of shares outstanding, which puts me at a very small fractions of 0.1% of ownership. And then I tried to make a calculation based on other companies that have sold or gone public that are like ours. What was the market cap or value at the time of the liquidity event, which was my estimate was $500 million. And then I did all the math, and I thinking, hey, like this is going to be worth hundreds of thousands of dollars. And the calculation told me that my options were worth 19,000 total at the time in the future, right? Not at this point right now, but if the company sells for what they think they should sell for or goes public that way.
Right.
And then that didn't even include the fact that they had raised $350 million, that investors are going to have what you said, a 1-to-1 or even further, a preferred payout first.
Yep.
And so when I left that company before the liquidity event, I decided not to exercise my options. And then the company did end up going public, and the market cap at time of going public was $450 million. And so you could sort of go through the math and see, but that was my personal, that was the first time for me that I did the calculation and like really opened my eyes to the fact that this is for many employees, especially as you start to either as the company gets later stage and you join later, or depending on what level you are or even what role you are, it can be pretty insignificant overall.
Yeah. Yeah, I think there's a couple kind of lessons in there. Is that number one, as a company gets to like in using your example, there's two things I want to talk about. Number one is the math and how you could have maybe understood that earlier, or maybe not. But and then number two is when you get to like series. My philosophy is like, look at RepVue, we're a pretty early stage company, right? We don't have tons of cash. Like we're probably not paying quite market, so everybody should probably get some equity. Yeah, as you get to Series B, C, when you've raised $300 million, you should be able to pay reasonable market, right? Maybe you're not in the top 20% of payers for that job, and equity is a secondary thing. And I always hesitate to ever like try and sell people on the fact that they're going to make a lot of money off equity because it's just not reality for most people. Even if the company does well. And so I think that's just one thing that people should consider is like, when you get later, say they should be paying market. A lot of them probably are. And the other thing is your experience with the 30K shares, and then you calculate it's worth $19,000. These are questions that are easy to ask. Like when you raise the money, when they like you knew what the exercise price was and you knew how many shares you had. Those were facts that were in your paperwork. That's easy to understand. They raise money. It's like, all right, what's the price per share when you raise that money? Well, now it's $1.15, right? And it's like, well, whoa, that's not as high as I thought. It's not as high as I thought because there were that many shares outstanding. And so I've said also in the past, like, ask how many shares outstanding there are. But the thing about asking how many shares outstanding there are is like it just allows you to back into that per share amount because you know what the valuation of the company is. So I almost like going straight to the source of the core data, which is this is your number of shares, this is the cost that it's going to cost you to exercise them. We just raised $100 million. The value of the shares now is $2. Okay. And you know that they want to go public, and ideally, so maybe we can double that to $4, right? Because we're going to double revenue, right? But you have a really good sense of current value, and then what is the upside, right? And your people don't realize a lot of times, like if you said the company went public, was that the outcome? Is that what it was?
They did go public, yeah.
So and there were call it 300 million shares. So what happened was before they went public, they did a reverse stock split, and it was probably in the area of 20 to 1. And what that means is that you would have then had whatever that 1,500 shares. The value would have been 15x. If they did the only reason they do that is because if they went public with 300 million shares at a $450 million valuation, what's the price per share?
$1.50 or something.
Nobody wants that.
Yeah.
Institutional investors in many cases are actually prohibited, like internal, policy, like, well, it has to be above this, and maybe not like prohibited like legally or things like that, but it's $1 stock, right? That's why you don't see it, right? You get in these it's the same reason people like Amazon or whoever, I think Google or Facebook just did a split and it went from 2,000 to 200. Retail investors can't buy $2,000. So it's 200. It's mental, even though you can buy fraction. But so they do that reverse split, and then all of a sudden you have 1,500 shares, and then they're worth a reasonable amount, $15, $20, $25. The problem is the assumption that people have is that, well, a stock it'll probably be worth $15. It's not going to be worth $15. That's totally irrelevant. What's going to be worth is the value divided by the number of shares, right? So there's a lot of mechanics that go on behind the scenes. So I was an employee, I was an executive at a company that I was at for many years, and we went through that process and went public. And so I witnessed all these things firsthand as they happened a few years back. And so there's a lot of things that I didn't know until I saw them happen. That and nothing is like necessarily, the only thing that I would characterize as like nefarious is like just be more transparent. right? Just be transparent, right? Like, so people understand, because I do think companies kind of sell the dream on like, look, this would be worth, Chris, you can make $200,000 off this. Well, yeah, if the company's worth $10 billion, right? Otherwise, probably not, and so I try to be conscious about that in my own kind of daily workings of like, look, it's upside, you know.
But yeah, most people are suggested to say treat this like it doesn't exist almost as an employee, right? Like,
Yep.
yeah.
And the same goes when you exit. If you leave the company, like I said, it's the most common outcome. Probably a lot of people leave before there's exit. If you leave the company, cut the check for all or some portion of that. If you decide based on the information that you have that it's in your best interest to do that, and then just it's sunk money, right? It's don't like count on that for your house payment in May of 2024. Otherwise, you're going to probably be disappointed. And you'll be a month behind on your payment. So just treat it as gone. And if something happens, great. It's if you can afford to live the lifestyle you're accustomed to with that money not coming back to you, then that should factor into your decision.
Cool. We got one more topic, and then we're going to get into questions. So, Angelica or Todd, if you're doing that, feel free to queue up some questions. And if people have any other things that have come up, whether it's your own personal situation or you want to go deeper on some technical concept that Ryan mentioned, feel free to drop that in the chat, and we'll definitely go into it in more detail. The last thing that I wanted to talk about, and I think a lot of people are wondering this, is that like how a lot of people are wondering if the company raises a Series D and they raise $150 million, is that good or bad for the average employee because of the concept of dilution?
Yeah. It's less about the amount of money that they raise. It's more about, is the company increasing the valuation, right? Yes, you are diluted. I think dilution, it plays a role, but what I like to communicate is, yes, as a percentage of the total pie, you probably do have less, right? The percentage will drop because what happens, and just mechanically, so everybody knows what happens when companies raise money, they have a set number of shares, right? So what shares are those new investors buying? Well, the company is actually creating more shares, right? They're just literally creating a new bucket of shares, and they sell those, right? And so that's why there's dilution. Basically, like you think of it like a pizza. You have a slice of pie. Well, the pizza just got bigger, right? And your slice, 2,000 shares, remains the same. So that's dilution. But at the same time, if you say, well, I have 1,000 shares, and the last time we raised money, I know it was worth $2. And this time, even though I have less as a percentage, it's worth $5. That's more, right? There's more money there, right? So I don't worry as much about the dilution there. Frankly, it probably hurts founders the most in terms of dilution, right? Because they typically have such a large chunk and that sort of thing. But so I think the dilution question is there's just another variable in there. I don't like to think about, is 150 million good or bad? The question of, is it good or bad for me, is answered by, what is the value of my set of shares now? Has it gone up, right? Like, in terms of the absolute value of it. And when you hear about companies like, well, we raised money $100 million at a $500 million valuation last year, and now we raised 200 at $1 billion valuation this year, more than likely that's going to be better for the employee, right? Because there's just a lot of, there's just more, your shares are just worth more. So, when it's a flat round or a down round, which, does happen, then there's dilution and your shares are not worth as much. But so that's how I like to think about the dilution aspect of it.
Yeah. To narrow in, just my takeaway on that is to focus on the price per shares outstanding or price per share outstanding rather than the valuation or the number of shares that you have, just so you get a very clear sense that the average price of my shares and the value of my shares go up or down instead of having to do a lot of math, right? The valuation plays a component of it, but if the valuation went up by a little bit and the amount of shares went up by more, then you would actually have a potentially lower value. So getting right directly to the most recent price per share, I think, is the takeaway there.
Yeah, and because the cost that you will have to pay for those shares when you exercise is not going to change. That's going to remain constant permanently.
All right. We just created a nice little, we just set a nice table and would love to get into some questions if people have some specifics about their situation or however. Let's queue them up.
All right, so we have one question from the audience. They'd prefer not to come on, so I will ask it for them. How do you make sure to get your shares even if you no longer work at the company when they get acquired?
How do you make sure you get your if you no longer work at the company? There's different types of shares. For early stage tech company, like most what you see I mentioned earlier are these incentive stock options. When you leave the company, you have 90 days to make a decision as to whether you want to acquire those shares. So that's a decision process that has to happen. Like when you're that decision should factor into whether you leave the company or whatever, or even if you're laid off or whatever, fired, you still have 90 days to acquire your shares. So that information is already set in stone, right? Like you need to make sure, like not all companies are as like, like I mentioned, we use that platform Carta to manage our equity stack or whatever. And it gives you notification, hey, you have 90 days, make sure you do it or you don't. The company should give you paperwork that has that information in there. If the 90 days lapse, then you lose all your share. You don't get anything that you have not exercised. If you've not exercised those options, 90 days expires, you're done. You will get no shares and nothing. So you need to just make sure that at the time of leaving, you're clear on what the plan is. A, do I buy them? B, how do I buy them? C, let's get that done.
Awesome. We don't have any questions, but I did want to hone in. Justin, who I don't think is on here anymore, mentioned about how their company, the shares are available as the same class as the ones at the VC zone, and they've actually, like, the company has been sold or 3 times in the time that he's been there over a 6 or 7 year period of time.
Yeah.
And the equity pool was handled that way. I'd just be interested if you have any commentary on that.
Yeah, I mean it's not standard usually, and I know Beyond Trust. I don't know details around how their equity stuff is structured or anything like that. I mean, like anything, anything and everything is negotiable, right? When later stage firms, venture capital firms, and funds come in, right? Typically, they're not going to. I mean, founders can negotiate anything. So I don't want to speak to Beyond Trust specifically. It just I think that sounds like a good thing for the employees if all the shares are treated in the same class. It's pretty unusual, particularly when you have early money coming in, like when there's a lot of risk on venture capital. They're going to want to put that clause in there. But then what sometimes can happen is those earlier stage venture capital dollars that went into the company, they actually exited when the later stage money came in. So and that's not uncommon necessarily, is that they'll take some money out if there's a big round at a high valuation versus some little seed round that went in really early, that they'll take the money and be happy about it. And so that could play a factor into it, but that sounds good for the employees at Beyond Trust.
Awesome.
I've got another one where the person didn't want to come on.
Come on, guys, let's go.
Yeah, let's go.
The question is sharing the cap table with employees common, or is that typically reserved for leadership and finance? And for the audience, if you could just kind of explain what the cap table is as well.
Yeah, I mean, the cap table is really just a chart of who owns what and how much. That's the cap table. I would say it's not really common, and I don't think it's really valuable for employees to have all that information. So I would typically recommend, like, I wouldn't necessarily share the cap table. What's valuable for employees, like I said earlier, is just how much do I own, right? Or what's the value per share, right? And like I said, like either way, like what I've told our employees is that this is your value per share after the fundraise, and they obviously know how many shares they have, and we tell them what the valuation was too. So you could, there's no metrics we're not giving them. And I think it would be awesome if all companies did that. But no, I don't think there's, I don't see like really a need for other people to see the full cap table. And even the full cap table doesn't show typically like employee, it just shows like employee bucket, right? And then it shows like the institutional investors, right? Your founders and your VC, and how much they kind of own, if there are any large angels. And then there's a bucket that's typically like employee bucket. So I don't think it's really that critical.
All right, we've got another one from Neil. He's going to come on and ask.
Thank you, Neil.
Yeah, no, thanks for speaking to this. I think it's one of those topics that is hugely impactful, but for whatever reason, like we don't talk about it, So my question is, I've read a little bit about this because I tend to work at startups, but I'm still unclear. Are there tax benefits to exercising our shares as soon as we can? Like obviously this presumes you believe in a positive outcome for the company. You're obviously putting your capital in, you're buying the shares. So I've read that like they can be taxed as like long-term gains or you go.
There are benefits. So let me just say this first out of the way. Obviously, you're making a decision to invest, to put your money into this early stage company. So there's significant risk, obviously, in doing that. But let's just say, for the sake of it, that you personally come to the decision that it's in your best interest to do that and to pay for those shares, and you exercise them. And typically like there's vesting schedules, and so a lot of times you can put, it's not large amounts of dollars if you're in early. The tax benefits, and you have to look and make sure you have an incentive stock option. If you have an incentive stock option, what you said is accurate. Like when you exercise, you're not going to be due, and you should check with your tax person. Of course, I'm not a tax person, so I want to just clear that up. This is just from my personal experience, is that, you can start the clock on the capital gains, for your, when you exercise, right? So then if there's not an exit for over a year, then you get the capital gains, versus if there's an immediate exit or liquidation event, then the tax is just treated like income to you. Now it's different if you have what's called a non-qualified stock option. That's a little bit different. So you'd want to look up the rules related to that. And like I said, I'm not a tax person, but I believe the non-qualified stock options, you would be taxed on the spread when you exercise. That's why most companies, there's certain reasons why sometimes you have to do an NSO, but most of the time it's an incentive stock option. So, look, and Google is a good resource for this, believe it or not. Like, I'm sure you've done it before, but the very basics of it are two things. Number one, do you believe the company will be worth something because you're making a very risky financial decision? And then number two, yes, if it is an incentive stock option, then there can be, you can try and figure out how to work that long-term capital gains clock to save a lot of money in taxes.
And so would it be, there's like three variables here, right? Because there's the price of the stock, that, like when the options were granted to you, right? That is like locked in. So based on like the last time the valuation of fundraising, whatever, I don't even know, right? And then there's the point in time that I choose to buy them and exercise. Is that stock value like reassessed in any way at this point in time? Or can I assume that like sort of it's still locked into what it was sort of granted to me at, or is currently at, based on additional rounds of fundraising? And then there's obviously what you said, the spread between.
So the market value let's assume we're talking about an incentive stock option. Let's just say they cost you 10 cents each, okay? And so you bought 1,000 of them, you put $100, they're 10 cents each. The current value, like, we raised money at this valuation, doesn't matter. The value at the next fundraise doesn't matter. What matters is when those are liquidated, when you sell them, the delta between 10 cents and the amount of liquidation, that's the taxable portion of that. If you've held it for more than 1 year, it's long-term gains. If you've held it for less than 1 year, it's just treated as income. Does that make sense?
It does. Yeah. Thank you so much. I appreciate it.
Yep.
Awesome. Thanks for your question, Neil. I think we got one more.
Yep, we actually have two, I believe, from Bob. So Bob, welcome.
No, I'm always good for a bunch of tactical questions, Chris. Hey, certainly appreciate you having this topic. And, unfortunately, 5 minutes into your presentation, my CEO pinged me and I had to jump. So I missed the bulk of the presentation. So forgive me if any of this is a repeat here. But on one contract in the past, I'm usually the first person through the door on the sales side, right? So a lot of risk, pre-equity, pre any sort of rounds of fundraising and proof of concept. So in the past, I'm basically jaded. I've never had a successful exit, right? So they've always expired worthless, and so I have a couple questions. On one contract, there was a stipulation that obviously you had to purchase them within 90 days of having left the organization, but then if they didn't have an exit event within 12 months, then that stock was like expired worthless or something like that. It didn't make any sense to me. So I didn't execute them anyway. I wasn't going to execute them anyway. But I was curious, how common of a stipulation is something like that if you purchase the options and then if the company doesn't have an exit event in a timely manner, they disappear. Have you ever heard of anything like that?
I mean, look, I'm not, talking to everybody about all their plans and this and that. It's the first time I've ever heard of it.
Me too.
It wouldn't seem. I mean, look, what would be the benefit of doing that? Like, the benefit of doing that is like you're going to get those shares back as a company and dump them back into the pool and screw the employee. Maybe. I mean, that's the way it feels, right? If somebody has worked for the company and they leave on good terms, bad terms, or any terms, it doesn't matter, and they want to exercise their options, have at it. And then maybe we'll do something, you put in work and that's your stuff. So it seems weird. I've never heard of it before. There could be some things that I'm missing about it that I don't know, but it doesn't sound like something I'd be a fan of as an employee or a founder.
Yeah, I wasn't a fan of it either. So based off of my jadedness, I'm curious about how strong of a position I should take on future endeavors. Because again, I'm usually going in pretty high risk where I could be out of a job in 6 months anyway. So like things that I've considered negotiating in the future would be like single trigger, full vesting, accelerated vesting on what happens is, as after a couple rounds of equity, the new equity VC or whoever brings in their management team, and I've been layered out before,
Mm-hmm.
So the question is, if that occurs, having to come up with 400 grand or something to buy out your options when you're being exited through the door is a tough proposition. And so I'm really curious about how strong of a position should like an early head of sales going into an organization take on single triggers, full vesting, and the company paying for them in certain separation events.
Yeah, I mean, it's some of that could be negotiable. I think the double trigger thing, which for those who don't know, that just means like double trigger is if an exit happens and then you get removed within X time period after the exit, then you get to accelerate your shares. Generally, I think there's other things in there related to that. So I think that's reasonable. 400,000 seems like a lot of money. There actually are limits on the 90-day thing. If you leave for whatever reason, like you have to do it within 90 days. If the company extends that, then there's some tax things that you'd want to look up related to ISOs versus NSOs that you need to be cognizant of. And like I said, I'm not a tax person, so I won't speak to them, but I'll just point out that you should look that up. And I mean, a lot of it comes back to like there is a lot of risk. I would hesitate to like take 40% of what you could earn somewhere else to go work at these companies. Yeah, maybe you take 20% less or 15% less because of what's happened to you thus far. So I don't know if I'm answering your question effectively or not, but it comes back to vetting the founders a bit too. Like, what have they, that's a big part of it is trust, and who is it that you're working for? And do you believe, like, a lot of the negotiation also happens when the founder does the sale, like or the exit, right? Like you can do a lot of things when you're negotiating a sale of your business, right? Like, hey, I want all my employees to accelerate a year of vesting, or I want, what I mean? Things like that. Or I want, there are things that you can do as a seller of the business that can benefit. And so I hate to say it like this, but a lot of it does come back to trusting the person that you work for, to know that they'll typically look out for your best interests in mind, and they have good control over the higher level decisions versus like, the board told me to do this, or the board told me to do that. Well, like, if you're the CEO, like, what, you're not, controlling those decisions, that can be a potential red flag as well.
That's
Bob,
a great answer.
Yeah, a couple other things that I'll add, like, you've gone 0 for 3. Maybe you could try a different scenario, right? Maybe you enter in at a little bit of a later stage, or maybe you join a company that isn't raising money and has stock options. I just wanted to throw that out there as well, is that you found yourself in a particular situation that matches your skill set and your experience, but there's nothing stopping you from like trying a different situation.
Yeah, I think I'm all about Series A or B next round. I
There
think
you go.
I am addicted to the early stage stuff. As you know, there's a lot of opportunity and fun to be had there, but there's certainly a lot of there's a whole lot more security and maybe financial opportunity with after someone's actually raised a round, right?
Mm-hmm.
Hey,
Yep.
I appreciate the response.
Yeah, great to have you, Bob. Always appreciate your questions. Ryan, this has been awesome. Any closing thoughts?
No, I mean, I think, closing thoughts, first of all, for those of you who don't know what we do at RepVue, our core mission is to deliver transparency in companies specific to the sales org. And we don't have like all this detailed rich data on like the equity stuff that we've been talking about, but we help people vet the company and make sure it's the right company for them. And I think that's a good kind of parallel to some of these conversations, which are, it's not just about the metrics and the math and the numbers. A lot of it is about the team and the people and the leadership. And we've heard multiple different examples of, oh, they did this or they did this. What that tells you is that a lot of different things can happen. And so are the people that are making these decisions the types of people that you want to align yourself with? So I think that's just a really important thing for not just these types of jobs, but for any job in the future that people are evaluating, is to think long and hard about that, and do plenty of research before you make the decision to join. But yeah, love talking stock options and equity, and happy to do it.
Yeah, I love that. So anyone that doesn't follow Ryan, feel free to give him a follow on LinkedIn. He puts some good stuff out there. Yeah. And for all of you here, you probably know, but for those of you that don't, we do this every other week. So twice a month, we have an expert come on and join us and share information on topics. Would love to have you. I think if you sign up for this one, you're actually on the recurring series, so it'll show up on your calendar next time in case you want to join. And so, Ryan, really great to meet you officially over Zoom, and appreciate you being here, and thank you for sharing all the knowledge, and hope to catch up with you again soon. And for everyone
absolutely.
here,